We've been talking about using managerial accounting information to help managers make decisions. In Chapter 8, we're going to look at 6 specific decisions that a manager could make. And so let's look at the process for making a decision. It's going to be based on the goals of the business. And so we can identify specific courses of action that will help us achieve those goals. Okay? But then we have to decide which course of action to take. And so we'll gather the data that we need to make the decision, choose the best alternative, and then we'll go forward with that decision. Afterwards, though, we want to compare the actual results with our projections. When we are gathering and analyzing information, we're going to be dealing with some projections or estimates. After everything's done, we want to see how accurate were those projections so that we can make the process better for the next decision that we need to make. So we need to distinguish between relevant and irrelevant costs. A relevant cost is a cost that's going to be different between two of the alternatives that we're evaluating. If we're going to incur the cost, whether or not we go with the course of action, it doesn't matter, right? We're only looking at the costs that are going to be different between the courses of action. So we're going to be projecting future costs and future revenue, but we also, in addition to considering the numbers, the quantitative data, we want to look at some qualitative factors, the things that don't have anything to do with the numbers. Irrelevant costs are the costs that won't change based on your decision. So they don't differ between the two different alternatives. As I said, if you're going to incur the cost no matter what, it's irrelevant to the decision. Sunk costs are costs that will not be relevant. So a sunk cost is a cost that you've already incurred. You can't get it back, so we don't factor it into the decision. Okay. So here's an example. When we're trying to buy a new machine, we don't consider what we paid for the old machine. Right? We will consider the price of any new machines that we're looking at, that we're considering buying, and any maintenance costs that'll be different between the new two machines will be considered. I taught my daughter about sunk costs years ago when she was in high school. We were going to a play. We had bought tickets to a play. She really wanted to see it. And right before we were to go to the play, I found out she has a test the next day and she didn't study for it. And I said, well, then you shouldn't go to the play. And her argument was that she needed to go to the play because we had already paid for the ticket. And I said to her, that's a sunk cost. We've incurred that cost whether you come to the play or whether you stay home and study. So that's how she learned about sunk costs. She ended up staying home and studying. And so we said the numbers is the quantitative data, and that's what we're going to be calculating. And we're going to show what the best course of action is. Basically, if it improves operating income, it's the best course of action. However, managers also have to consider qualitative information. So things that don't have to do with the numbers. We're going to look at discontinuing operations. Well, what's going to happen? We know what the effect on operating income is by closing a plant, discontinuing an operation. But then what else is involved? What is the bad morale? What is the bad feeling in the community because people in the community have lost jobs. Maybe we will now lose customers because people have lost jobs, right? So we have to talk about these other things other than what the change in operating income and kind of factor that in when we go ahead with the decision. Opportunity cost. So you might have talked about opportunity cost in your econ class. Opportunity cost is what you have to give up in order to pursue a course of action. Okay. So in econ, I think they talk about what's the opportunity cost of coming to school. What could you be doing other than coming to school? Well, the time that you're spent in school, you could be doing other things. right? A lot of my students say, well, when we're in the classroom, they say, well, I could be home sleeping, right? So the opportunity cost of coming to school is giving up sleep. You could be taking on more hours at your job, right? So the income that you're losing because you're not at your job is the opportunity cost of coming to school. And so we will look at courses of action. When we do one course of action, we have to give up another course of action, and that is a relevant cost that we need to consider in the decision-making process. Okay, so we're going to be looking at the relevant information, which is also called incremental analysis. Incremental means we're looking at the changes in the cost. Okay. And so these are the 6 specific decisions that we are going to be analyzing, and we're going to be showing the right way to approach them and how you can use our managerial information to make these decisions. So the first one is a special sales order. Okay. So we have a customer that comes to us, they've got a bigger order, a one-time purchase, and so they want to get a discounted price. So here it is. Should we accept a request to produce 200 units for a special order? Our product normally sells for 50. The customer wants to pay 30 because they have such a big order. They think they should get it, and they have come to us and said, will you fill the order? We'll pay you $30 per unit. So the very first thing we have to do is ask ourselves, do we have excess capacity to fill the order? Okay. If we do, then we can consider it further. We need to look into it further. If we don't have enough capacity, we don't have excess capacity to fill the order, then that's easy. The answer right away is no, we're not going to pursue it. Then we also have to ask, is the special reduced sales price high enough to cover the incremental cost of filling the order? That's what we need to analyze and determine. If the revenues are greater than the expected cost increase, then we can go ahead and accept the order. If the revenues are less than the cost increase, then we need to reject the order. And then if the numbers say we should go ahead and take the order, if we can see we'll increase operating income with this order, and our inclination is to accept the order, we still need to ask ourselves further about the qualitative factors. Will this special order affect our regular sales in the long run, right? Is this customer going to come back a month from now and want to get that same special sales price, right? Are other customers going to find out that we gave a discounted price to this customer? Is one of our regular customers going to come back and say, hey, I've been paying 50. You gave this other customer 30. Why am I paying 50? They may all come back and want that special sales price, right? So those are the qualitative factors that we need to consider. If our regular sales in the long run are going to be affected, then we need to reject that special order. So here's the information on the customer that wants to buy 200 units. Our regular selling price is 50. They want to pay 30. Well, here we can see our costs, direct materials, direct labor, variable overhead, fixed overhead, comes to $34 a unit. So at first glance, it looks like, why would we sell it for 30 if the unit product cost is 34? However, they tell us that the special order would not affect the total fixed manufacturing costs, and there is excess capacity. So these fixed manufactured overhead costs, okay, that's incurred whether we accept the special order or we don't accept the special order, right? These are the costs that are being allocated to our department. So since we're going to incur these costs, whether or not we take the special order, these are not going to be relevant. So we do not factor in the fixed manufacturing overhead costs because we have the excess capacity and will incur those costs whether or not we take the order, right? That's what we know about fixed costs. They don't change when volume changes. So if we make more of these units, right, we're not going to incur more fixed manufacturing overhead costs. So this is what incremental analysis looks like. We take our revenue from the special order, subtract our variable expenses, get our contribution margin. Now, the only fixed expenses that we will consider would be any additional fixed expenses that are being incurred due to the special order. So, for instance, if the special order, they want a special logo and we have to buy a special, design plate to make the logo, right? That would be an additional fixed expense of the special order. So in our example here, we said it was $30 per unit. So for the 200 units, our revenue would be $6,000. Our variable expenses that we need to consider are the direct materials, the direct labor, and the variable manufacturing overhead. And so if we look here, 11 plus 8 is 19, plus 10, 29. So it was 29 per unit, 5,800 for the total order. So that left us with contribution margin of 1 per unit, 200 in total. We didn't incur any fixed expenses. So the increase in operating income from the special order would be 200, right? So if we're increasing operating income based on the quantitative data, we would accept that special order. Okay, so this is the example. So assume the customer wants a special logo on the product, which will require us to buy a special stencil for $500. That would be an example of additional fixed expenses. Well, now the contribution margin minus those additional fixed expenses means that we will have a decrease in operating income. Our operating income will go down by $300. So we would reject that special order. Okay. The next one is pricing. And so when we're talking about pricing, we have to ask, what is our target profit? We need to determine how much will our customers pay for the product. And in order to determine how much our customers will pay, we have to look at whether or not we are a price taker or a price setter. So what type of company would be a price taker, right? You would have to accept the price that customers are willing to pay if you make a product that is just like other products that your competitors are making. So if you're in a highly competitive industry because it's the same product that everybody else is making, then you have to take the price that's set by the market. A price setter would be a company that makes a unique product. Okay. So no, they can't go anywhere else to get the product because we make a customized type product. So we get to set the price. We get to determine what the price is because they can't go anywhere else to get it. So if you're a price taker, a highly competitive industry, and you make a product just like everyone else makes, right? The price is going to be set by the market, and then you have to figure out a way to get your desired profit and manufacture the product for the cost that's remaining. So the market price, we said, is your starting point, subtract your desired profit, and then you get your target costs. And you have to figure out how to control your costs. So your development costs, your design costs, production costs, marketing, delivery, service costs, all have to fall underneath the total target cost. So our total target cost, we take the revenue at the profit minus the desired revenue at the market price and subtract our desired profit. And usually your desired profit is stated as a % return on your assets. So we have promised our investors a certain %. You have to keep your investors happy or they're going to pull out their money. So we have to make sure that we're getting the profit that we have promised to our investors. So whatever left is what we can spend or what we can incur as costs to make the product. So when you're using target costing, you may find that the actual cost is less than target total cost, and that's cool. You can go forward, but you may find out that the actual cost is greater than the total target cost. So then you got to find a way to get underneath your target. So if you increase your sales, then you'll find lower fixed costs involved. change the product mix, or differentiate your product.